markets move, the world takes notice. This is NextMoney Signal, your daily briefing for those who make financial moves that matter.
Welcome to the deep dive. Today, we're digging into a pretty wild story.
Yeah, it's quite something.
Someone going from what, a 7-hour job, all the way to a 150 million property portfolio. And starting with just like 13,000 pounds.
13,000, yeah. It sounds almost unbelievable.
It really does. So our mission today for you is figuring out how. How do they manage that scale without some huge inheritance or, I don't know, a lottery win?
Exactly. And it's not just about getting big bank loans either.
Right. That's what's interesting. We're looking at leverage, sure,
Yeah.
but a broader kind, especially how they use people, equity partners.
That's the core of it, really.
Yep.
That initial 13K versus the 150 million end figure, well, it screams ingenuity, doesn't it? Not just cash.
Definitely.
And leverage in this context, yeah, it's way more than just debt. It's about making every resource work harder. And that absolutely includes other people's money and their belief, frankly.
Okay, so equity partners. Let's unpack that. How did it work, practically speaking? Were they just like finding people on the street with spare cash?
Yeah. No, not quite. It was much more targeted. This person, they found investors who specifically bought into the deals being presented. They saw the potential.
Okay.
So the deal was investors put in some capital, and in return, they got a slice of the pie, a share in the profits, ownership in the property itself.
Right, like a mini joint venture for each project.
Exactly.
Yeah.
And that massively cut down how much our main person needed to bring to the table themselves for each deal.
Makes sense. Sharing the risk, sharing the reward. So where did the banks fit in? Did having these partners make getting loans easier?
Oh, absolutely. It was a huge factor. That partner equity, it basically acted as a big chunk of the deposit. So from the bank's perspective, the deal looks safer.
Lower risk for them.
Lower risk, better loan-to-value ratio. It just made securing the main finance, the bank debt, for the bulk of cost much, much easier.
So you got this powerful mix.
Yeah, partner money gets you in the door, bank money gives you the scale, they work together.
Could you walk us through an example, maybe with round numbers, say $1 million property?
Sure, good idea. So imagine a £1 million deal. The bank might agree to lend, say, £750,000, right? Standard 75% loan to value.
Okay.
Now, instead of finding the whole £250,000 deposit, our person raises, let's say, £225,000 from those equity partners, which leaves only £25,000 they need to put in themselves.
Wow. Okay, so 25 grand of their own money controls $1 million asset.
That's it.
That's insane leverage. What is that, 40 times?
40 times, yeah. 40 times leverage on their own capital, just in terms of controlling the asset. It really shows how stacking different types of capital can just explode growth.
It really does.
Yeah.
Now, the source material also talks about this idea of a knowledge gap being more important than a wealth gap. What's that about?
Yeah, that's a really key insight, I think. This person figured out that the biggest hurdle wasn't always the lack of personal cash. It was more about not knowing the market, not understanding how to structure deals, or, crucially, how to actually attract that investment.
Okay, so knowledge was the real bottleneck.
Exactly. So they focused on learning from people already doing it successfully. Bridging that knowledge gap was how they created the opportunities in the first place.
Yeah.
They realized knowledge connections. That was the real currency.
And that leads into this founder energy thing they mentioned. It wasn't just having the knowledge, but projecting it.
Precisely. It's one thing to know your stuff, another to convince others. They put together really compelling deals, meticulously prepared, and presented them with real conviction, almost like, look, this is happening. It's a great deal. Are you in or out? That energy, that proactivity, that was vital for getting those early partners on board.
Creating that sense of urgency. FOMO, almost.
A bit of that, yeah. But backed by solid homework. It allowed them to scale without needing anyone's permission in the traditional sense.
So this whole approach, it really turns the usual advice on its head, doesn't it? It's not save up a massive deposit first.
Not at all. It's much more about resourcefulness, strategy, collaboration.
The powerful signal then for anyone listening who thinks you need a fortune stashed away to even start thinking about property investment.
Exactly. It shows it's not just about deep pockets. It's about smarts, partnerships, and really leveraging every angle you can find.
Okay, so let's wrap this up. For you listening, the big takeaways seem clear. Look beyond your own savings account. Think about how you could potentially leverage other people's capital through, properly structured partnerships.
And actively chase the knowledge. Find the people who know more than you and learn from them. That's key to making those partnerships work.
Right. And the real aha moment here, maybe, is that the focus wasn't on getting rich first and then investing.
No, it was the other way around. Create good opportunities, present them well, and then find the partners. The drive to learn and execute was the fuel.
So, final thought for everyone listening. What knowledge gaps might be holding you back right now in whatever you're trying to achieve?
Yeah, good question.
And how could strategic partnerships, finding the right people, maybe help you amplify your goals, whatever your starting point financially?
It really shifts the focus, doesn't it, from what you have to what you can access and how creatively you use it.
Absolutely. Food for thought.